How the big beautiful bill impacts your 1031 exchanges. Are you thinking of doing a 1031 exchange this year? Well, the big beautiful bill just gave you some new tax advantages that you're going to want to know about. Most investors use 1031 exchanges to defer taxes, but now you can pair that with another tax strategy when you're acquiring your next deal. By the end of this video, you're going to understand how the big beautiful bill affects your 1031 exchange strategy and ultimately how to combine tax deferral with tax acceleration to maximize your wealth. So quick recap here. What is a 1031 exchange in real estate? A 1031 exchange lets you sell an investment property or property that you use for business and defer capital gains and depreciation recapture taxes by reinvesting into a like-kind property. When we're talking about like-kind property, we mean investment for investment. Doesn't matter what kind of real estate that you're buying, as long as it's for investment purposes, you can find another real estate investment purpose property and exchange into it. What are the rules? Well, you must identify properties within 45 days after you sell, and you must close 180 days after you sold your property. You must use a qualified intermediary. You cannot touch the cash. Once you do the closing with an attorney or escrow agent, they have to transfer the money to the QI or qualified intermediary, and then they're going to be placing that cash into the next transaction for you. And why do this? Well, if you do it right, you can defer taxes for decades, growing your asset base and compounding your wealth. So what the big beautiful bill changed in regards to 1031 exchange? Well, it brings major upgrades to your 1031 exchange strategy. How does it do it? Well, number one, restores 100% bonus depreciation for property placed in service after January 19th, 2025 through 2030. It raises the Section 179 expensing limit to $2.5 million. And it re-energizes cost segregation studies and capital improvement strategies. This means that your replacement property in a 1031 exchange not only gives you tax deferral, but gives you now additional deductions. So we want to supercharge your 1031 exchange play. Here's how we do it. Step one, sell your property via a 1031 exchange. Step two, reinvest in a like-kind property that qualifies for a 1031 exchange that is at or above the sales price of the property that you're exchanging out of. Step three, apply the 100% bonus to the components of the property that you're exchanging into and maximize additional depreciation losses on the new property that you're buying. Step four, maximize and utilize those losses. So offset your passive income coming in from that property and other real estate properties with those losses, or strategically use those losses to offset a capital gains tax from real estate sale. This creates a double bonus because not only do you defer taxes on the property that you sold, but you're generating new losses from the property that you bought. And you can utilize those new losses to offset that passive income and other sales that you may have with capital gains. So what are the best properties to acquire with this type of strategy? Well, you want to find properties that qualify for a 1031 exchange and have this bonus depreciation eligibility. Properties like self-storage that have a lot of short-term property that can be accelerated with depreciation. The buildings, the walls, the roofs, the concrete, the asphalt, all these components can be accelerated and can drive additional depreciation on top of your 1031 exchange. Mobile home parks. There's lots of short-term property with water, sewer, power, roads. All of it can be bonused out and add additional depreciation to your 1031 exchange. Multifamily with capital improvements needed, such as remodeling units, redoing a roof. Any building improvements or landscaping improvements could qualify for bonus depreciation. Triple net properties with stabilized tenants, or DST or tenant in common property investment vehicles that have additional depreciation benefits included. These assets are bonus friendly and 1031 eligible. So be sure to look at all your options when 1031 exchanging. So let's look at 1031 exchange plus bonus depreciation as a strategic tax strategy. So the 1031 exchange, what's it do? It defers taxes from the prior sale. Bonus depreciation accelerates deductions on the new acquisition, a step up in basis. This eliminates taxes permanently if the property is inherited. I hate to break it to you, but the only way to not pay tax is if you pass away. And in that case, there's a step up in basis where the property is appraised at the new value and the heirs can sell the property, not paying any tax, wiping out capital gains and wiping out the bonus depreciation recapture. Cost segregation study unlocks massive year one write-offs phantom passive losses generated from bonus depreciation. A TIC, a DST, or a passive option to invest in. This unlocks mailbox money where you will now not be actively managing the property. You will be passively receiving checks, and it allows you to step away from having to manage your commercial real estate or take on additional risk by getting more debt or being responsible for the operations. And this would be a passive vehicle to now transfer. This eliminates risk because you'll no longer have to be on the debt, operate the property, or be responsible for future improvements. So finding a passive option is a strategy to 1031 into. Check out the video in the comments below. I share how to 1031 exchange actually into a real estate fund. And that is a strategy where investors are stepping away from the business, but still want the benefits of owning commercial real estate. So what should you do right now? Action steps. Well, look at your portfolio. Is it time to sell any assets that you've maximized the value or you no longer believe that the property fits into your portfolio, either due to declining population or the property has a lot of outdated improvements that you do not want to make, or it's just too management intensive? Evaluate what properties you would like to sell. Now evaluate properties that you are looking to buy. What asset classes do you like? Is it storage, small bay industrial, mobile home communities, apartments, industrial? Doesn't matter. Identify that property and then start to look at how much bonus depreciation can I accelerate out of this property. You can do this by talking to a cost segregation study engineer. I'll leave a link in the comments. You can talk to one, and they're very reasonable on their pricing. This way you can get an idea of how much depreciation in addition to the 1031 exchange you can extract. Next, sell that property and get an escrow. Maximize the value of your property and now work with a qualified intermediary so that they're going to hold the funds for you. Next, talk to your real estate accountant who focuses specifically on real estate investors. He's going to help you break down what the tax liability is if you just sell the assets without any of these strategies, plus what you need to do on a 1031 exchange, meaning how much property do you have to buy to exchange out of the property you're in? And then lastly, how much bonus depreciation can you pull out of the next property? And then finally, decide if you want to actively or passively invest in the next property. Are you looking to continue to be the operator, continue to take on the responsibility of owning commercial real estate or residential real estate? Or would you like to look at passive options like real estate funds, partnerships, or DSTs? Once you're clear on that strategy, it's about timing. We have 5 years now to make the best decisions in commercial real estate investments. We have certainty that these laws are in place and they're going to be here for at least this timeline. Now's the time to make key decisions because this timeline is going to affect the remainder of your real estate investing career. So check out the next video about how to 1031 exchange effectively. I break down all the rules, who you need to work with, and why and when to use a 1031 exchange and not use a 1031 exchange. So check it out.